From the campus of Yale University, this is Business Talk with Jim Campbell, nationally syndicated across the country on the Biz Talk Radio Network and coming to you from our flagship stations, Yale Radio WYBC and 1490 AM WGCH Greenwich. All talk and all business, 60 minutes of radio with leading figures from the world of business along with the business of politics and sports. The Fed's version of its refusal to bail out Lehman Brothers is refuted. Was it murder on Wall Street? A financial whodunit today on Business Talk with Jim Campbell. Lawrence Ball is professor of economics. He's also chairman of the econ department at Johns Hopkins University, research associate at the National Bureau of Economic Research as well, and he's a visiting scholar at the International Monetary Fund, the IMF. His research focuses on unemployment, inflation, along with fiscal and monetary policy. He's author of Money, Banking, and Financial Markets. Just issued a provocative white paper, The Fed and Lehman Brothers. Welcome, Larry. How are you?
I'm fine. Thank you for having me.
Honored to have you on. This is kind of the first investigation, I think, in a detailed way into why Lehman was allowed to fail on that fateful September 15th, 2008. And I want to start almost at the end first, which was, in your estimation, how big a mistake was it? What was the impact of letting Lehman go down?
Well, with the qualification that wasn't the main point of my paper, I would say the impact was pretty big. I mean, it's hard to do counterfactual history, but I think if Lehman had not failed, the whole financial crisis would not have been so severe. And if the financial crisis were not so severe, the Great Recession would not have been as bad, and the economy would be better today.
Yeah, and I know that's not the subject of your report, but I wanted to put into perspective exactly what we're talking about here, how important it was. Is it as simple or as real as the fact that somebody had to have the bad luck, somebody had to lose in the musical chairs to show that there was some sort of a moral hazard here?
Well, I think politically somebody was going to lose, that with each bailout, the political pressure against it increased. So in that sense, if we take politics into account, it was probably inevitable that somebody would have to fail, and Lehman was in the wrong place in line at the wrong time. I mean, in economic terms or in legal terms, there wasn't a need for anybody to fail, but politically it was probably inevitable.
Okay, one more thing before we dive into exactly why they failed. We had David Stockman on a while back, and he said that they should have let all five major firms, which would have included Goldman Sachs and Morgan Stanley after Lehman, they should have let them all fail. And as you know, with the lack of liquidity, was going right through them all like a wildfire. What do you think of that?
That sounds pretty out there to me. I think we saw that having one of the big five investment banks fail was quite disastrous, and I can't even really imagine if all five of them had failed. I mean, it probably would have been worse. I mean, one thing I agree with Henry Paulson and Ben Bernanke is that if AIG had failed, we might have had something comparable to the 1930s with, who knows, 20% unemployment. I mean, if all of the big investment banks failed, I can hardly imagine.
All right, let's get to your research, which is really a great piece of detailed work. Give us the overview. Why did Lehman Brothers fail, and maybe help us understand the difference between liquidity and solvency?
Okay. The reason Lehman Brothers failed, briefly, like all the investment banks, they made some bets on real estate that went bad, and they had a very thin equity cushion, so they didn't have to lose too much money before people started to question their solvency. But then what was fatal was that when people started to lose faith in the firm, they cut off short-term funding. So all the investment banks did a lot of short-term borrowing to support illiquid assets. And it was essentially a modern version of a bank run when suddenly the money they depended on to operate disappeared. So that was what caused them to fail, along with the fact that the Fed decided not to intervene and lend them the cash that they needed to keep operating.
And this is called the Primary Dealer Credit Facility, which could have provided immediate funding from the Fed. They said that they lacked the collateral, and therefore they legally could not loan. Where do you come out on that? And also, was their balance sheet way overstated? Were they legitimately in a negative net worth? You go into that in pretty good detail.
Okay, well, so starting with the second question first, they reported $28 billion of equity. People who looked closely at their books from Barclays and Bank of America, which were both considering buying Lehman, estimated that they overvalued their assets by $15 to $30 billion. So if you subtract 15 to 30 from 28, you get something between negative $2 billion and plus $13 billion. Mm-hmm. So long story short, I think they were borderline solvent. Having said that, you mentioned the distinction between liquidity and solvency. What did them in, I mean, it didn't really matter, certainly in the short term, whether they had plus $2 billion or negative $2 billion in equity. What did them in was running out of cash or the liquidity crisis. Again, like a textbook bank run, a bank might be in perfectly good health in terms of solvency and its business, but if for some reason its deposits are taken away, it can't operate. So the primary dealer credit facility, that was set up after the Bear Stearns crisis, and its exact purpose was that if other investment banks got in trouble and ran out of cash, that the PDCF would lend the cash. And then the central question becomes, under Section 13.3 of the Federal Reserve Act, the borrower needs to have enough collateral. And making a rather long story short, I estimate that Lehman would have needed to borrow about $88 billion, and that they had at least $131 billion of collateral acceptable by the PDCF. So it would have been very feasible and legal and safe for the Fed to lend. And that contradicts what Fed officials have said.
Contradicts what Bernanke and Paulson have represented ever since then.
Yes.
Let me ask you a question now. First off, I've always wondered why Wall Street firms allowed themselves to be susceptible to runs by relying so much on repos and commercial paper, and that's just short-term funding for people, which can dry up literally overnight. Drexel went down that way. Bear went down that way. Why do you think that is?
So that's an interesting nuance. Most of their short-term borrowing was repurchase agreements, not commercial paper, which in less technical terms means that it was collateralized lending. Mm-hmm. And I said it was a textbook bank run. The way it's different is in a bank run, if there's no deposit insurance, if you don't get to the bank in a hurry, you lose your money. So there can be a self-fulfilling panic when everybody rushes to the bank. People thought, and this is very clear, people thought that repurchase agreements were a great idea because they were collateralized loans, and actually with haircuts, so the collateral was more than 100% of the loan. So the people lending the money were protected in case of default, and that in turn meant that they would never have any incentive to cut off repo financing, even for a firm that was in trouble. And that actually first the Bear Stearns crisis and then Lehman, that was a big unpleasant surprise that and still not fully understood why the repo lenders were so quick to cut off funding when it wasn't really risky for them.
Yeah, that's interesting too, because that to me is part of the whodunit. Another thing that I glean from your work here is that, and not to get too technical, but J.P. Morgan acted as a clearing agent on the repurchase agreements and tri-party collateral position, and they suddenly sought bigger haircuts or bigger collateral coming out of them, and they did it right around the time that they took over Bear. So it looks like it could be potentially kind of a conflict of interest there, right? That they helped put the knife in Lehman.
I don't know. There's a less sinister interpretation, which is that they were trying to protect themselves.
Okay.
You're right. It's rather technical. In the tri-party repo market, part of the time the repo lender is lending the money, and part of the time during the day, J.P. Morgan, the clearing bank, was lending the money. And J.P. Morgan realized that in some scenarios they could be left holding the bag. Although, again, it wasn't really that risky because it was collateralized. But they realized that Lehman might fail to pay them back, and so they demanded collateral, and that was on top of the collateral that Lehman was already pledging to the ultimate repo counterparties. So it was another unexpected drain of cash.
Unexpected, and became a self-fulfilling prophecy, which you would think that J.P. Morgan would not want to help bring them down. Business Talk with Jim Campbell of Biz Talk Radio Network, 350 stations around the country. We'll talk next about how the Fed did force the failure of Lehman Brothers. And we're back with Johns Hopkins University Econ Professor Larry Ball. And in his recent paper, he basically makes the point that the Fed has misrepresented why they let Lehman file and go bankrupt and end a 140-year elite bulge bracket firm on the street. Why don't you take us through how they did, some of the steps that resulted in almost forcing Lehman to file for bankruptcy? And by the way, can legally the government force anybody to file, a private enterprise to file for bankruptcy to begin with?
So that's an interesting question. And I think one thing people don't realize is that the Fed did not just passively let them fail. The Fed actually did things to make sure that they failed. And the first thing they did is on the famous Sunday afternoon, September 14th, called the lawyers and executives of Lehman Brothers down to a dramatic meeting at the New York Fed. And this is all recorded in popular books like Andrew Ross Sorkin, It's Too Big to Fail, and said, you need to declare bankruptcy, and we don't want to hear any argument. Go back to your headquarters and write a bankruptcy petition. Now, there was the detail that the federal government and the Fed do not, in fact, have the legal authority to tell the board of directors of a private corporation whether to file a bankruptcy petition. So what they did, though, was to take actions to ensure that Lehman didn't have enough cash. So Lehman filed for bankruptcy at 1:45 a.m. on Monday the 15th, which was 6:45 a.m. in London, where their London broker-dealer was going to open at 9 and had no cash and was supposed to pay somebody $4 billion at 9 a.m. and didn't have it. And
amazing.
The Fed ensured that happened. And again, it gets a little bit technical, but the Fed actually, in hopes of easing the crisis somewhat, provided cash to Lehman's broker-dealer in New York, but denied cash to the broker-dealer in London. So the London unit failed, and that was their obligations were guaranteed by the overall Lehman, by the holding company. So then the holding company had to declare bankruptcy.
Not to interrupt you, but I will. It's that not providing the London broker-dealer sub of Lehman, and right after that they did offer for the broker-dealers in London of Morgan Stanley and Goldman. Am I right?
That is right, and that is something which I've seen almost no mention of. And actually, I was well into my research and writing my paper before I noticed that. So again, it's a little technical, but the primary dealer credit facility lent to the New York subsidiaries of investment banks and not to subsidiaries in other places. But no, and Lehman Brothers requested support for their London broker-dealer. It was turned down, and then almost exactly 7 days later to the hour, basically on the Sunday night when Morgan Stanley and Goldman Sachs thought they might not be able to keep operating, the Fed did a 180-degree turn and lent to the London broker-dealers of Goldman and Morgan Stanley.
Now, you said that they did lend to the broker-dealer subsidiary in New York, but why wouldn't they lend to Lehman Holdings? And again, that sort of ensured that the overall company would fail.
Well, so again, it's easier to say what's not the explanation. So the explanation is not anything about insufficient collateral or illegality. The only way I can understand it was they had a tough situation in that they did not want the headlines, and Henry Paulson, who was running the decision-making, did not want the headlines to say government bailout. They wanted the headlines to say government stands firm and doesn't lend. So they wanted somebody to have to declare bankruptcy, but at the same time they wanted to minimize the effect on the economy, and they thought that keeping the New York broker-dealer in business for a while might mean that having the holding company fail wouldn't be all that bad for the economy, which turned out to be a bad gamble.
And talking about that in scale, you mentioned that $88 billion would have allowed Lehman Holdings to survive, and the Fed, the government, ended up lending AIG $182 billion. Yes.
And they actually, it got less attention, but at one point Morgan Stanley
yes.
said we have a liquidity pool of $50 billion of cash, and what people didn't know at the time was that they had borrowed $100 billion from the Fed. So the Fed lent a lot of cash to a lot of people.
By the way, that raises another point. Lehman goes down September 15th. September 21st, that primary dealer credit facility is made available to Morgan, Goldman, and Merrill Lynch, and accepted, I believe, the very collateral the Fed would not accept from Lehman. Is that right?
Yeah, so actually there are two. So the Fed actually, on September 14th, the Fed expanded the collateral. So actually, again, the ironic thing about the 14th and the 15th was that the headlines say no bailout. But actually on the 14th, the Fed actually did lend $28 billion to Lehman's broker-dealer,
right,
and vastly expanded lending to everybody else by broadening the collateral that the primary dealer credit facility accepted. So, but those, in the media were minor technicalities that were not, again, the headline was all about the bankruptcy filing. The thing on September 21st was different. That was, so September 14th was expanding the collateral. September 21st was giving credit to the London broker-dealers as well as the New York broker-dealers.
The derivative contracts start to fall apart, right, because the counterparties want more collateral. Is that something where the Fed could have forced the counterparties not to seek greater collateral at that time, or something like that might have helped them survive a little bit longer?
Let's see. I'm not sure. I hadn't thought of that. I'm not sure the Fed has the authority to do that, or that would even have been necessary.
Okay.
One of the liquidity drains that Lehman faced were these collateral calls, but in my calculations, Lehman had plenty of assets available to borrow all the cash it needed for all of its liquidity drains, including these collateral calls.
Okay, tell us now, as we get down to the last minute and a half, the Fed was running the show, but who was the real decider? Because this is interesting, too, that this should happen.
Well, the real decider, briefly, was Henry Paulson. And that's interesting because under the law, the Federal Reserve has the sole authority to decide on these things. But Henry Paulson, it seems, simply showed up at the New York Fed and started telling people what to do, and they did what he told them to do.
You know, what was interesting as we finish this off, too, is that these guys are so stuck on this story that Chairman Bernanke says, this became a catastrophe and a calamity. They'd rather admit that they completely screwed up than that what they actually really did.
Well, although, again, but then the rest of the story is our hands were tied legally. We knew it would be a calamity, but we couldn't break the law.
Business Talk with Jim Campbell. We're taking on Wall Street in Washington from the Radical Center. And next, we'll explore a what-if case if Lehman could have survived, and then whether they deserve to survive. And we're back with Professor Larry Ball of Johns Hopkins. He's got a white paper out, The Fed and Lehman Brothers. And just to summarize, we just went, the decider was Hank Paulson. And why exactly didn't the Fed rescue Lehman? You're saying that the legal justification really doesn't hold water. Is it just the politics of it? Didn't want to be Mr. Bailout? What else do you attribute?
Well, I think the number one factor was, as Henry Paulson has been widely quoted as saying, he didn't want to be Mr. Bailout. So it was, and that's actually very understandable. There was intense political pressure. And one could even argue that it was wise for the Fed to take that into account. If the Fed gets politicians too angry at them, that could threaten their independence. But in any case, so I think it was politics, but that's not what they say. I mean, another important factor, though, was that they did not fully anticipate all the bad things that were going to happen as a result of the bankruptcy, the panic, the run on money market funds, and so on and so forth. And actually, and that's another place where what Fed officials have said since the bankruptcy is different from what was actually happening and what they were saying before the bankruptcy. I think you mentioned Ben Bernanke and others now insist we knew it would be a calamity, we knew it would be a catastrophe. Again, it's so unfortunate our hands were tied legally. But at the time, by coincidence, on September 16, the next day, there was a meeting of the Federal Open Market Committee, the Fed officials in Washington, and there was a discussion of Lehman, and not very much concern that anything calamitous had happened.
And in fact, I do think that they completely misunderstood, were blindsided by the impact of looking like the derivatives market was going to fall apart. Because AIG had all the credit default swaps, and when Lehman's contract started to fall apart, it was going to be a blow-through right through AIG. Do you think?
I'm not sure. It gets so complex. I think, a lot of it was just the shock value and the panic, I think. But
all right, let's go through some what-if cases. If they'd done certain things and whether Lehman would have survived and what the difference. In the first instance, right after Lehman failed, they instantly allowed Goldman and Morgan Stanley to become bank holding companies, right?
Yeah.
And that seems like it could have easily applied to Lehman.
Absolutely. And one detail of the story actually is that over the previous summer in June or July, Lehman actually inquired about becoming a bank holding company, and Fed officials were discouraging and said that's not a good idea. But yes, they could have done that. I mean, I think a number of things could have happened. Mm-hmm. I mean, as is famously known, Lehman was almost rescued by being acquired by Barclays. And then at the last minute, that deal fell through because of some complex objections by British regulators. One possibility is simply that if the Fed had kept Lehman going for a couple of weeks, let's say, by lending cash, that the Barclays deal could have been untangled, and that might have happened.
Don't you think also that Barclays is looking at this thing and they're saying, wait a minute, these guys are going to be bankrupt in a day or two. Why wouldn't we get them at a fire sale and wait? It seemed like self-fulfilling to me.
That's a good question. I don't know. I mean, there was really a deal written down. I think Barclays thought that they were going to actually acquire the whole Lehman Holdings and avert the bankruptcy. And again, and the Fed thought that was going to happen. The Lehman thought that was going to happen. I think it was a big surprise to everybody on September 14th that fell through, again, because of these arcane regulatory issues. At that point, Barclays then decided to buy the parts they wanted from the bankruptcy estate. So maybe afterwards Barclays actually was happy at how it worked out, but I don't think that was the plan from the beginning.
Now, I think you raise a good point in that if they had stepped back and looked at a longer-term resolution, hadn't pressured the deal, maybe set up a special purpose vehicle off balance sheet to take all that illiquid real estate that was collapsing, that might have been a more sensible way to go about it.
Yes, so Lehman, several days before they went bankrupt, announced a plan to spin off some of their real estate assets into a real estate trust. I guess the popular lingo is splitting the firm into a good bank and a bad bank, the real estate trust. Actually, Ben Bernanke discusses that plan in his memoirs and has actually some mildly positive things to say, saying that kind of plan sometimes works. That wasn't such a bad idea. But then Bernanke says, well, obviously they didn't have time to implement that plan. But, of course, the reason they didn't have time was that the Fed wouldn't provide liquidity support.
It seems,
so that's another possible outcome.
The whole thing seems like a self-fulfilling prophecy. Now, we had Steve Forbes on, and he harks on one big thing, which is the mark-to-market nature of that, and that which actually forced the assets to be, marked down, which results in the insolvency. Do you think that there should have been a hold to maturity or a not forced to mark-to-market?
Well, I mean, certainly the Fed should have taken that into account. When we talked before about their borderline solvency, maybe a little bit positive, a little bit negative, we were implicitly talking about mark-to-market values. Given the distress in financial markets, fundamental values, or values based on future cash flows, were almost certainly higher. So, on that basis, Lehman was very likely solvent and viable in the long run. So, I'm not sure about formally changing accounting rules, but certainly that should have been taken into account, and that's a reason to think that Lehman could have continued.
Now, Goldman was partly saved by an equity injection of $5 billion by Goldman into Goldman Sachs. And is it that they couldn't find someone to just? I know that the Korean Development Bank was looked at, but they couldn't seem to get it done. And the second part of this question is, in long-term capital management, the Fed forced Wall Street to put together the bailout fund, if you will. Was that possible in any way here?
Okay, well, remind me of the first question again. I'm sorry. The
first one was, that an equity injection, which, by the way, is what the TARP ended up being.
Yes. Yeah. So Lehman had, over the preceding 6 months, tried very hard to get investors. So the Korean Development Bank, various other sovereign wealth funds. They called up Warren Buffett. They called up Carlos Slim, and they never could make a deal. And what people, including Henry Paulson and Ben Bernanke, have said, which actually sounds plausible to me, is that Richard Fuld, the CEO, didn't completely face reality and thought his company was worth more than it was, and that was why he insisted he set too high a price. I think, though, by September 14th, the price they were demanding went way down. They essentially were going to sell the whole firm to Barclays for almost nothing. So again, I think it's quite possible that, or even likely, that if Lehman had stayed in business for a matter of weeks or months, that getting equity injections like Goldman did, like Morgan Stanley did from a Japanese firm, that would have again been part of the solution. Now, the second question about long-term capital management. So again, one nuance of the story is that part of the agreement for Barclays to acquire Lehman involved a consortium of Wall Street firms financing some of Lehman's real estate assets. So the Fed and Henry Paulson were actually successful in getting this Wall Street firm to do something similar to the LTCM deal instead of the Bear Stearns deal where the Fed actually financed the assets. So that was part of the whole package. which again fell apart at the last minute because British regulators wouldn't approve it because of complicated things about financing the firm in between the deal and the final approval by shareholders.
And some of the sad things that are coming out of that by forcing all this, you talked about they were going to sell the investment management division, which was mainly Neuberger Berman, and you use the figure they're trying to get $2 billion for it, and then elsewhere it says that it was actually probably worth $8 billion, and they're basically giving it away.
Yes, there were classic fire sales that once they went bankrupt. Also, the New York broker-dealer, there was great pressure to sell that very quickly. So a lot of the loss of value from the bankruptcy came from these fire sales of subsidiaries.
All right, we'll finish up the story in our final national segment, and we'll talk about did Lehman deserve to fail? With Professor Ball on the Fed and Lehman. And, I think of a 150-year-old firm. It was a partnership that the first in the management should be responsible for is like a doctor, do no harm. Clearly their business model failed, and it was a result of management failure. And I want to talk about some of the components. The first on their leverage. It was 33-1 at the end. They were investing in all these illiquid assets, including they did a Archtone $22 billion deal at the top of the market. At the same time, Goldman was starting to short the market. So, I mean, how do we account for the fact that these guys are highly paid guys and they screwed up?
That's an interesting question. It's not obvious to me that they should be judged that harshly, or at least graded on the curve compared to the other investment banks, because what they did was not that different from what Goldman and Morgan and Merrill Lynch and Bear Stearns did. All of them invested heavily in real estate. All of them had very thin equity cushions, very high leverage. All of them relied on short-term funding. I think where Lehman was a little bit different was, as you mentioned, Goldman Sachs relatively early in the game started moving away from real estate and betting against it. Lehman actually made a strategic decision in 2006, 2007 to go more heavily into real estate on the theory that prices were being pushed down artificially by panic about the mortgage crisis and that they could buy cheaply and then make a lot of money when markets returned to normal. And, of course, that didn't work out. I guess it's a cliche to say in capitalism, if you lose money, you fail, and that's what ought to happen to you. Here, a financial institution like this, the damage to the overall economy and the number of people who lost their homes and lost their jobs is so great that I think whether Lehman got its just desserts or not is really kind of secondary to the fact that there is such tremendous damage to the economy.
Good points. And I was, though, bothered. The chairman and CEO was Richard Fuld, and I still remember him before the testifying in the House or the Senate and basically saying, for the rest of my life, I'll have no idea why we weren't bailed out. But this is a guy who took $345 million out of the firm the prior 5 years. So what he was asking for is heads I win and tails I want to win too.
Certainly he made mistakes, but in his defense, I mean, he's been so vilified that it makes me want to defend him a little bit.
Okay.
He said, I don't understand why we weren't bailed out. I think what he meant by that was there was no good reason to treat them differently from all the firms that were rescued.
And we should say that's the whole thesis, basically, of your work.
Yes. So again, the Fed says Lehman was unique in not having enough collateral to get a loan. That just doesn't fit the fact. So I actually have some sympathy for Richard Fuld thinking that this was arbitrary and unnecessary.
Okay, and a good way to segue from that is compare it briefly to the other cases. I mean, Bear Stearns did get $30 billion and was allowed to set up that bad bank through Maiden Lane. AIG gets bailed out, and they're not even under the Fed's auspices, et cetera. Go out. GE essentially bailed out on commercial paper too, right?
I don't know as much about GE. I know a lot about Bear Stearns and AIG. And actually, again, one way in which I'm afraid the facts don't fit the official story. The official story is AIG had good collateral, Lehman did not have good collateral.
Right.
The facts seem to be much more the opposite, that Lehman could have survived just with this over-collateralized overnight liquidity assistance, which, long story short, is not very risky. With AIG, they set up this 2-year line of credit, and the collateral was the equity interests in AIG's insurance subsidiaries. And the Fed has never said, or has actually explicitly refused to say anything about how much these subsidiaries were worth. It's very unclear to me whether the collateral for the AIG loan amounted to anything worth the $85 billion that they initially got on September 16th.
Interesting, and I don't want to get too grassy knoll on conspiracy theories, but Hank Paulson's your decider, as you say, and there are some people that feel that bailout was to get money backdoor to Goldman on the derivatives, credit default sweep, collateral, and secondly, that maybe Mr. Paulson didn't like Lehman Brothers too much. Is that all too grassy knoll?
I think that's a little too grassy knoll. I think Paulson, succumbed to political pressures and letting Lehman fail, which and most human beings would have been very affected by those political pressures. I think then what happened with AIG is that he realized that the economy was heading for disaster, and suddenly being Mr. Bailout didn't look all that bad compared to being Mr. Great Depression worse than the 1930s. So the stories about Goldman versus Lehman, I honestly think that is probably secondary.
And I agree with that, by the way. I think Paulson's pretty much of a straight arrow. Now, obviously, your findings very provocative. You're essentially, uncovering, challenging the Fed's official version that they have never walked off of. Have you gotten any sort of feedback formally or informally? From the Fed, from Paulson, from Bernanke, any of those sources?
I have talked to a few people I know at somewhat lower levels in the Fed who say that they don't agree with me, and we haven't really discussed it in detail, but certainly people I know at the Fed have not liked my conclusion. I have not heard anything from I don't think Ben Bernanke has said anything to my knowledge. I think one reporter called up Henry Paulson, and Henry Paulson said some kind of boilerplate about I stand by everything that I said in my memoirs.
Interesting. Is there a moral of the story that you come up with this, whether it's transparency or truth in government or politics versus analysis? Is there something that in your mind you'd like to sort of express?
Well, probably the number one thing is transparency. Anybody who follows the Federal Reserve knows that Fed officials, Ben Bernanke for that matter, Janet Yellen, talk a lot about the importance of transparency in monetary policy. The Fed is politically independent, but they have a responsibility to be transparent, explain what they're doing and why they're doing it. And they simply did not live up to that standard in this episode.
You've been listening to Business Talk with Jim Campbell. Thanks to Johns Hopkins Professor of Economics Larry Ball, who's done a great piece of work uncovering the demise of Lehman Brothers. The paper is called The Fed and Lehman Brothers. And Larry, one last thing. Where could people take a look at it?
The easiest place might be my website at the economics department at Johns Hopkins.
Thanks again to our national audience for listening. Thanks to Larry Ball. See you next Sunday on Business Talk with Jim Campbell. Once the most powerful woman on Wall Street, the former chief financial officer of then-collapsing Lehman Brothers, speaking out for the first time on her fall and her journey back to work-life balance coming full circle with Erin Callan. Today on Business Talk with Jim Campbell. Erin Callan Montello was the Chief Financial Officer of Lehman Bros, the only female member of its executive committee during the height of the financial crisis from late 2007 until mid-2008. Her tenure as CFO coinciding with Bear Stearns' collapse and then ending just prior to Lehman's bankruptcy filing. She was the public face of Lehman during this period. She was recognized in 2007 as a woman to watch by Fortune magazine in their annual review of the most powerful women in business. The New York Post ranked her as the third most powerful woman in New York in 2008, behind only Hillary Clinton and Anna Wintour. Her new book, just out recently, Full Circle, a memoir of leaning in too far and the journey back. Thanks, Erin. I've been looking forward to this. How are you?
I'm great, Jim. Thank you. Thanks for having me.
And we'll just say right off the bat, there's still matters under litigation with Lehman, so we're going to stay away from certain topics. We'll just get that out of the way right off the bat. Did Leaning In, was that a play on Facebook's Sheryl Sandberg Lean In?
Yeah, yes, it was. I felt like that's actually become a kind of a reference in current society, and a lot of women in particular have focused on the message from Lean In, and really the genesis of the book came from the launch of that novel. I mean that piece of work back in March of 2013, where I wrote an op-ed piece for the New York Times as I was thinking about what the message was from Sheryl's book. So it is a reference to it. It's not intended to be antithetical to it. It is a reference to it for sure, though. Okay,
you were only in the CFO position for 6 months, so it's got to be one of the biggest rises and biggest falls ever. As we talked about, the highest-ranking woman on Wall Street at the time, and really amongst all folks your age at 42 years old. How did you process it?
It took me a long time to process it, I guess, is really the key aspect of it. I didn't process it well at the time, for sure. I like anybody, and you're in a career and you're sort of moving generally in an upward trajectory, and you're taking the next step and the next promotion. It felt that I was on a track and going in a direction. And as I talk about in the book, as that was happening, I think I was losing my way a bit, but I wasn't so sure of that. But as I got closer sort of to what I consider the pinnacle, I was definitely feeling that something was missing, that something wasn't quite right. But this was what I had spent my entire 20-year career headed towards, so it was hard to take myself off that track and really get any perspective. So it wasn't until sort of what I call the dramatic events around my leaving Lehman and everything that happened with respect to Lehman's bankruptcy that I think it created enough of sort of an earthquake in my life to sit back and really take a hard look and reflect on where I was and who I was as a person and what I had become and whether that was something that I was happy with.
All right, let's look at Lehman for a sec, because we're talking a rise and fall there. 158 years. I always think of something that prestigious, that the fiduciary responsibility should be first, do no harm. And you guys had let the leverage go to 44-1, which essentially means 1% asset write-down. You wipe out your capital. Looking back, does it seem kind of inevitable, or does it seem almost irresponsible, or how do you look at that? And obviously I'm not blaming you because you were only in the job briefly.
That is a hard thing for me to comment on at this point, other than to say that it was not out of the norm, so to speak, in terms of industry practices. As you point out, it was what it was when I took the job, and there was sort of an accepted amount of leverage that generally the investment banking community was comfortable with, the rating agency community was comfortable with in terms of rating these institutions, even the shareholder and creditor community was comfortable with. So in hindsight, of course, it may suggest that there was more leverage than could handle the kind of really dramatic events that took place in the asset markets. But so in the context of the moment, it was really sort of in the norm of industry practices.
All right, let me ask this. Lehman culture kind of had an image of being very silo, house divided, traders versus bankers. There was the famous Glucksman-Peterson split. Lehman, American Express, when they split up. How much was the culture a contributing factor of inevitability, or it's what the firm thrived on?
Lehman had a fantastic culture, and I think if you speak with people from Lehman Brothers, most people will say how much they probably miss it, what an amazing culture there was. I think it had a very unique feel to it, and it was a tone set from top down. There's no question that, and I'm pretty confident about this, that in every investment bank, you have different businesses. You have banking that's an advisory business versus trading that's a risk-taking business in part. And there's always going to be some conflict between those parts of the business, and that's very natural and in some cases healthy, I think, to keep a check on each other. But I don't think that there was any kind of fatal cultural aspect at Lehman Brothers. I think that actually the culture, if anything, was responsible for the strength that the firm had for several years, prior to the crisis, and also for its ability to attract a lot of talented people. So I'm not sure I would put the cultural piece into the mix.
Okay. All right.
Let's
ask about the management mix now. I don't know if you've read Larry McDonald's famous book, Colossal Failure of Common Sense. And in his focus, he was on the third floor doing distressed debt, so they were actually shorting the mortgage market. The fourth floor, they were manufacturing the CDOs as fast as they could with a lot of lousy stuff going in there. And he maintains that the 31st floor, where you would have been, where Dick Fuld would have been, where Joe Gregory, was a ghost ship, not in touch. What do you think about that?
Honestly, it's sort of hard for me to know what that relationship was in terms of knowledge at that point. I mean, I said I only stepped into the job in December of 2007, so a lot had already happened, and in fact, most of practically every asset that Lehman was going to have on its balance sheet was already on its balance sheet at that point. So, in terms of really knowing how familiar Dick or Joe was with those particular positions, that's hard for me to know. I really had to focus on myself, as I talk about in the book, trying to get up to speed as a rookie CFO in a very challenging environment. So, my job was to get myself educated, to get myself as knowledgeable as I could about the firm's positions, and then to communicate that as well as I could to people around me. But it's hard for me to tell really about the point Larry might have been making on that.
Okay. Do you feel that Dick Fuld, Gregory, if you want to include it, took the requisite degree of responsibility they should have? I was always bothered that Dick was saying, why weren't we bailed out? And he had taken some $350 million out of Lehman in stock compensation, et cetera, which to me would have been heads he wins, tails he wins. Do you think that they did?
Jim, I think you can probably tell this from the tone of my book is I've really tried to take accountability for my own actions and not really sit in judgment of anyone else's actions, other than how they might have pertained to my situation. So I really do not want to finger point. I don't want to try to now stand in judgment in 2020 hindsight and say whether someone else should have taken some kind of accountability. I said I've just tried to step out and take my own lumps about what I think I did right and what I think I could have done better in my job.
All right. That's fair. You're a good diplomat. We got about 30 seconds, so this will be quick for you. Do you think you were treated fairly ultimately?
No, not particularly, which is why I left, actually. I think if I thought I had been, I wouldn't have left. I would have been there doing something at the time of the bankruptcy. But immediately after my resignation of the CFO job, which then I felt was painted as I was fired, I wasn't happy with how I was treated, and I did feel betrayed. So I left at that point. But if I had felt treated fairly, I absolutely would have been there to the last minute, to the end. trying to make it work in whatever role I could have done.
Completing the full circle comeback, it's very interesting in your book that all your big successes are coincident with relationship failures.
That's a good observation, Jim. I made my career the number one priority of my life. As time went on, what I like to tell people, particularly younger people, is that you don't make that decision. Most people don't make the decision at 18, 19, 20 years old. It's a decision that happens subtly. You erode your personal life and erode it little by little over time. And I took 20 years to completely erode it practically by just constantly putting a little more energy into the work part of my life and a little less energy into my personal relationships. So every time I'd get into a relationship, it start out okay, things would roll along. And then, subtly, I'd just start making decisions that would constantly place what I was doing with my job over the relationship, and ultimately they would fail. And it's not a big surprise how that would happen. Okay,
one final thing on Lehman. And after 6 years, you got a phone call from Dick Full. And you can tell us a little bit about that. And, the perception has always been that this guy just made you accountable. He hung you to dry, et cetera.
One thing that always sort of bothered me after the fact was I did like Dick as a person, and I did think he looked out for me most of the time, and I did feel good about working for him as a CEO. So when all the events happened and I felt betrayed and I left, I never knew quite how to square that with what had been my prior judgment. And Dick calling me all these years later really spoke to the fact that I think my judgment wasn't as flawed as originally maybe perceived, because he did call and he did talk to me about what happened and how bad he felt and how much he had respected me and how he had thought I was the right person for the job and how badly he felt about how all the events played out. So I do think there's a lot more to Dick than people give him credit for, and there's not a lot of people that probably know him very well, but I'm not going to say any bad things about him.
No, and to your credit, you said that you took the call and it meant a lot to you, but you were healthy enough at this point that it didn't change your whole world, your self-esteem. How about getting to the hero? One of the heroes of the story is Anthony Montella, who's your current husband. He emails you coldly after an interview with Maria Bartiromo, who we've had on. Talk a little bit about that big change.
Anthony's the reason sort of for everything. He's the reason I'm here right now. He's the reason I'm living a happy life right now. I have a beautiful daughter. And I say in the book, you think it would be the worst possible moment that this person who I knew from when I was a young kid in high school sees me and decides he's going to try to email me, guesses at my email just to say, hey, wow, I think you're doing something amazing, back and forth. And then, we finally get together, and he turns out to be the love of my life. And the person, however, on top of that, who grounded me and gave me some kind of foundation and something to hold on to, and most importantly, perspective. Anthony had gone through his own dramas. Anthony's worked in Midtown Manhattan as a firefighter, and his entire company was there at 9/11. It was his first day of vacation. He lost his company. He had to live with sort of survivor guilt, and he went down to the site right after. But, he was through a real drama, not the kind of drama I went through. He went through real drama, and he gave me a sense of perspective on what really happened and what life was about. And he's led me to this place now that I have real happiness, because I've really gone back to what I say full circle to the priorities I really grew up with, which was family and friends and relationships. And so he really is the hero of my story.
I call it the 3 Gs from your book, Golf, GOP, and God. What your father originally wanted you to do. Tell us who you are now, what you're doing now, what your mission is now.
My mission now is to raise my daughter as well as I can, be a great mom, be a great wife. I don't advocate this sort of strange way I've lived my life. I sort of had young women come to me and say, oh, isn't it great? You worked really hard for 20 years, on your career, and then you stepped out, and now you get to live, you're like basically 20 years of a personal life, or however long it's going to be. And I say, that's not balance. That's not a good strategy. That's not how you want to do it. So I've never achieved work-life balance. All I like to talk about is the fact that I didn't achieve it. I'm trying to live the other part of my life now, the part I completely missed out on when I was spending all my time at work. And I'm lucky and blessed that I get to do that. I get to focus on my daughter, and I get to focus on my husband. So it's a radically different life, but for the kind of person I am, I think I needed to do things radically differently than before.
So you're an all-in kind of person, obviously. So this is how you define all-in now. Do you think that at some point that you might want to go back and do something in the work world, or not, or this is going to be the mission?
Writing this book was something different, but something that wasn't exactly, being a wife and mother every day. Mm-hmm. I think I have a message to share that was the point of writing the book, and I really look at it as, I'm not sure. I really am going forward with, we'll see where things take us. I'm happy to have written the book. I've gotten so many amazing responses from people about how it spoke to them, how it made them feel better, how it inspired them, whatever it did. And I feel so good about that's what's come of it. So sort of just taking it each day and deciding, where I go with it, if I go anywhere with it. But I think going back to any kind of conventional finance job, no, that's not in the picture for sure. That's not where I want to go with things.
But maybe a good golf handicap?
Not yet. I just had a baby 15 months ago, so there hasn't been a lot of golf over the last 15 months, let's put it that way. But eventually, maybe. I'm hoping. Do
you have a final 30 seconds for young women and young men who are just going into this world?
The most important thing I could share, as I mentioned it a little bit earlier, but is, no one really starts out wanting to make their career their entire priority and wanting to give little to no energy to their personal life. But so we do make a lot of decisions every day that lead us to a place, or decisions we don't make. And you just have to be cognizant of, is that the direction you want to go? And when you make those little decisions, what are going to be the implications cumulatively over time?
Well, a lot of grace under pressure. And as I say, when somebody faces a fall, the issue is, do they get back up? And obviously, Full Circle is an appropriate name of the book, a memoir of leaning in too far and the journey back. It's self-published, which, by the way, was also interesting to me. You said that you guys even were going to mandate a work-life balance versus a publicity tour if you've used a major publishing house. I guess that's living your words. Thanks to Erin Callan. Thanks to our national audience for listening. We'll see everybody next Sunday on Business Talk with Jim Campbell.